over here. What he's saying is the bullish engulfing pattern here that I'm circling, this looks like an okay risk reward. If you buy here, what's your target? I would probably say up here. And, you know, we got here. We'll look at intraday later. You may have gotten a negative signal there on the intraday chart to tell you to get out. Remember, resistance and support is not to the tick. And one of the things we want to look at is, hey, is this a failure at resistance? You may have had a bearish engulfing pattern on the hourly chart there. And I would say in that case, that's close enough for my target to get out. We're going to look at some really cool things with intraday. Okay, so here we have a couple of signals here. The blue arrow, the first one, points to a doji. This is actually called a dragonfly doji, where the opening, the high, and the close are all in the highs of the session. It's really a hammer, but instead of a real body, it has a doji. But what are the stochastics showing us? Is there a positive crossover? Is the market oversold? No. With the bullish engulfing pattern, is the market oversold based on the stochastics? Yeah, it's below 20, 25%. And we then had positive crossover. So the idea is if you're using stochastics and you're really comfortable with it and you know all the nuances, and I certainly don't, okay, there are whole books written on stochastics, stay with it and just use the candles as that final confirmation. But you could also go kind of the other way by, if you're getting a candlestick signal, make sure if you're really keen on RSI that the RSI is confirming what you're seeing with the candles. Let both reinforce the other. Okay, bearish engulfing pattern, negative divergence. Okay, this, yes?
Sometimes when you see the divergences.
I'm sorry, the question is sometimes when you see what?
Sometimes you see the divergences, but the price will still keep going and making more than one divergence.
Okay.
So many times you get caught, and then you get stopped out, and then you see next divergence, you get stopped.
Okay, the question is when you see a divergence, sometimes the market will have a divergence and keep on going up or down. This is exactly what happened in the 1990s with the good old days in the bull market in stocks. I cannot tell you how many technical analysts I was saying the market's going to top out, we have negative divergence. This is why it's so important to use the candlesticks. Negative divergence is your alert. What's the raindrops? What's the final confirmation? The candles. Okay. So just because I see negative divergence doesn't give enough of a reason to initiate a trade. If I get a candlestick signal, also very important, and it leads nicely into the next slide, is make sure the market is not trending, because what's going to happen is if you have a strongly trending market, so this is the RSI, and notice how the RSI on the left side of the slide remained overbought, because the market was trending. A really good measurement of trending is ADX. How many here use the ADX line? Okay, if you don't, you really should think about using it to see if the market's trending. Essentially, in the ADX, I'm not going to get into the math about it, but the ADX line measures how much the market's trending. It doesn't matter if the trend is up or down. If the ADX line is ascending and is above, I'd say, 25 or 30%, the market's trending. So you could have a rising ADX line as the market is trending down. That rising ADX line just means the trend is more entrenched than you would have if the ADX line is flat or descending. So notice on the left side, the ADX line is ascending, very high, very strong trending market. You ignore oscillators, because what's going to happen is going to be pinned in the overbought condition and stay there. And notice how the ADX line at the red arrow here is moving down, is still moving down. I shouldn't say is still moving down, is now downward sloping. It's very low. It's under 25, 20%. What is that telling us about the trend of the market? Is it trending on this red vertical line? Is it trending anymore? Not. It's flat. Now you could use the oscillators. So for those not familiar with the ADX, read about it. It's available in all the charting packages, but it's a really good way of measuring if the market is trending or not, because the oscillators really should not be used in trending markets. Now, one of my favorite Western indicators, and this is perfectly fine to use with oscillators, Bollinger Bands. Bollinger Band is, for those not familiar, the default is a 20-period moving average, which is fine, and then it's 2 standard deviations above and below the 20-period moving average. Essentially, it means 95% of all the price action should be defined by the top and the bottom of the Bollinger Band. And what that means is, as the market gets less volatile, what's going to happen to the bands? Shrink. As it gets more volatile, it's going to expand. So, how do we use them? Another way to gauge overbought, oversold, which is separate, actually, than oscillators. Nothing wrong with adding this in addition to oscillators. So here we have a couple of negative signals here in the euro-dollar. Some doji, a bearish engulfing pattern, on your right. And, well, you'll see on most of our charts, on the Forex charts, and when I say our, on our newsletter, and also we do this on equity indexes, we'll almost always have Bollinger Bands, because they work very well as overbought or oversold indicators. So you can see how these confirm the top end of the Bollinger Band. So what this is showing us is the market is overextended. I really like Bollinger Bands. If you're not using them, you're shaking your head yes. If you're not using them, look at them. Now, if you trade individual stocks, sometimes it works and sometimes it doesn't. But if you get something like this on your individual stock, if you're trading stocks, and you see the top end is where the market stalls out, start following them, but they work really well, very well in the Forex markets. So here we have some bearish engulfing patterns, a shooting star, an evening star, and right at the top end of the Bollinger Band. Again, on the right side, we have some doji, some long upper shadows. And we can go through these pretty quickly. Okay, a doji at the top end of the Bollinger Band, a piercing pattern at the bottom end of the Bollinger Band. John Bollinger doesn't like to think of Bollinger Bands as support or resistance. It really should be gauged as the market's kind of reaching an extreme, and that's why I like to look at them. Okay. Here we have a group of signals. We have a bearish engulfing pattern, a shooting star, negative divergence. Okay, top end of the Bollinger Band. This is what we look for. And obviously, if you think, although we have that group of indicators, that increases the likelihood of a turn, but how do we know if we're going to pull the trigger on the trade? What do we always have to think about? Risk reward. You could have 20 signals intersecting at once. This is a plethora of signals, but unless it's a good risk reward trade, you don't do it. I don't care how many signals you have. And this one looks okay. This risk, I'd have to see what the risk is. But certainly, with the pushback up to the top of the bearish engulfing pattern, we could think about it.
Do the Bollinger Bands change your support resistance lines?
Do the Bollinger Band change support and resistance lines? I'll be still looking at the support and resistance area. So, for example, we might have, let's say we're at this point here. Okay, we don't know what happened here. Okay, our first support area, I'd have to look back here. I might have change of polarity. So we'd have that as S1. Let's assume this is S2. And the bottom end of the Bollinger Band, because you can extend them, would be my S3. So it's just another way of gauging support or resistance. They don't replace them. And what you'll see a lot of times is if we have a Bollinger Band coinciding with another reason for support, the markets very often will turn. So let's say we had the Bollinger Band at a major support area, very often the markets will turn. Okay. Now, one technique used a lot in the Forex market are Fibonacci retracements. And these are essentially, these are the major retracements, 38.2%, 50%, and 61.8%. So essentially, if the market rallies from 100 to 200, a Fibonacci 38.2% retracement would be 162. 50% is 150. To me, the most important retracement is 50%, because there are traders who will look at just 50% retracements, even on the equity side. Okay, although not many equity traders will focus as much on Fibonacci retracements as they do on the Forex side, a lot of people look at 50% retracements. So to me, that's the most important one. So essentially, the idea is if the market retraces certain levels, it could be a bounce area, but once again, only if confirmed by a candlestick signal. A Fibonacci retracement confirmed by a candlestick signal normally is not a reason for me to initiate a new trade. I really like